Imagine growing up in a family business. You work summers on the crew, you learn every job, and later you study business and engineering so you can bring new skills back to your business. And years later, you decide to step aside, negotiate a fair price for your shares, and plan to use your lifetime capital gains exemption. You expect everything to be straightforward. But then the CRA steps in and says, this is not a capital gain, it's a dividend. That's the story of Kathryn Carter and her family paving company in New Brunswick. Hi, I'm Amandeep Singh, CPA. In this video, we'll walk through what happened in Carter versus the King, and I'll break down section 84.1 of the Income Tax Act in clear, simple terms so you can understand what CRA was worried about and why the court said it did not apply. Let's start with the family business. Brown's Paving was started by Kathryn's grandfather back in 1950s. Her father Wallace took over and later invited his nephew Corey to join. Corey had civil engineering training and was good at estimating jobs. Kathryn, meanwhile, worked her way up from traffic flagger to equipment operator to running crews and handling compliance. She also studied business and engineering, bringing professional skills into the company. Together, Kathryn and Corey pushed for growth, bought equipment, and doubled the workforce and revenues. Wallace slowly stepped back but kept voting control. By 2014, Corey wanted more cost control and to shape the company his way. He asked Kathryn to sell her shares. They eventually agreed on a price of $600,000 with two conditions from Kathryn. She would be paid in full at closing, and the sale would be structured so she could use her lifetime capital gains exemption. Here's how the deal worked. Corey created a holding company, Corco. Brown's Paving borrowed $600,000 from the bank, giving the bank security over its assets. Now, Corey and Corco guaranteed the loan. Corco then bought Kathryn's shares using a promissory note. And immediately after, Brown's Paving redeemed those shares from Corco for $600,000 cash. Corco used that cash to pay Kathryn. She reported a capital gain and claimed her exemption. Corco had a deemed dividend but deducted it under the Act, leaving no tax at the corporate level. Now, why did CRA step in? And this is where section 84.1 comes in. What is section 84.1 in plain English? It's a rule to stop something called surplus stripping. Surplus is basically a company's retained earnings, its accumulated profits. The tax system expects that when you take those profits out personally, you'll pay tax on dividends. But dividends are fully taxable and capital gains are taxed at a lower rate. On the top of that, if you qualify, the lifetime capital gains exemption can shelter a gain completely. Now, without section 84.1, someone could try to get around dividend tax like this. Sell their operating company shares to a holding company they control, claim the capital gains exemption, and then later pull out the money from the holdco as a tax-free return of capital. That's what the law is meant to prevent. So, how does section 84.1 work? It only applies when an individual, like in this case Kathryn, sells shares of a Canadian company like Brown's Paving. And the buyer is a corporation like Corco, and the individual and the buyer don't deal at arm's length. Basically, they are too closely connected. And also, after the deal, the buyer corporation is connected to the operating company, meaning it controls the company or is tied closely enough through ownership. If all of that is true, unfortunately, section 84.1 steps in And when it applies, two things happen. First, it reduces the paid up capital of the shares in the new corporation, so you can't later pull money out tax free. Second, if you received cash or a promissory note, the law can deem that payment to be dividend instead of a capital gain, and that means, unfortunately, no lifetime capital gain exemption and full taxation. So in Carter, CRA thought Kathryn and Carco were not at arm's length. In their eyes, Carco was just a vehicle to let Kathryn turn what should have been dividend income to a tax-free gain. They argued Section 84.1 should apply and relabel her $600,000 as a dividend. They also argued Carco and Brown's Paving were connected immediately after the deal, which could check another box under the rule. But the tax court disagreed. Justice Graham carefully looked at the facts. On the arm's length question, the evidence showed Kathryn and Carco had separate interests. Kathryn had not been planning to sell Corey had approached her. They bargained hard over the price. Kathryn's only concerns were full payment and access to her exemption. Corey's concerns were different: how to finance the purchase, take on the risk, and increase his ownership. He and Carco guaranteed the loan. Wallace did not. That's real commercial dealing, not a coordinated plan to strip surplus. On the connected point, Wallace still held over 90% of the voting shares immediately after. So Carco did not control Brown's Paving, and there was no evidence Wallace and Carco acted together. That meant they were not connected as the law defines it. The CRA also suggested that Brown's Paving could have just redeemed Kathryn's shares directly, but the judge rejected that. The company had no right to force a redemption, and the deal only happened because Kathryn agreed to sell to Carco. In the end, the court found Section 84.1 did not apply. Kathryn's capital gain stood, her exemption was valid, and CRA's reassessment for 2015 through 2018 were vacated. The court also awarded her costs. So, what can you learn from this case? Motivation is key. Courts care about why a deal happened and who initiated it. Kathryn did not go looking to strip surplus. Corey wanted to buy her out. And second, independent negotiation does matter. A real back and forth shows the parties were acting separately, not as one. And thirdly, risk tells the story. Corey and Carco agreed to carry the financing risk that looked like a genuine purchase. And also, connection rules matter. Section 84.1 only works if the buyer corporation is connected to the operating company right after the sale. Here, Wallace's control broke that link. And don't assume CRA won't look back. Even family deals can attract scrutiny if they are structured with the holding companies. At Cloudiverse CPAs in Burnaby, we help clients navigate exactly these situations. Think of us like Google Maps for tax. We help you see the road ahead, where Section 84.1 might apply, where CRA might challenge, and how to document motivations and structure the deal so your story is clear. If you are considering a sale to family member, key managers, or through a holding company, reach out to Cloudiverse CPAs. We'll help you design a structure that keeps the deal tax efficient and dependable so you can focus on your business and family legacy without surprises from CRA. Thanks for watching, and I'll see you in my next video. Until then, bye.